Right, so looking for a stock to double, from my experience, there are three things you need to consider. First is the destruction of the stock, second is the quantitative management, and third is the qualitative execution. But for a beginner, it's not always easy to understand, which is exactly why I'm here to help you guys. Now, if you're new to the channel, my name is Sam, and on this channel, we strictly look for stocks that can double, triple, and even 10x your money. So if you're looking for stocks like this, make sure to drop a like, subscribe if you haven't already, because I'll be covering lots of other stocks that I believe have the potential to be in this category. Now, so far, I've already had 7 stocks double in my time of being in the stock market, and I'm expecting my portfolio to double in the next 6 months, which you can check out the video up here, which I break down in good detail for you guys. But in this video, I'll be talking about HIMS and HERS stock because it's a really interesting stock that I've been watching for a while now. I've seen earnings smash it over the last few quarters, yet the stock price is even lower than it was back in 6 months. So whether or not there's value here, we're going to find out. Now, first, in the format, we're going to be talking about the destruction of the stock, but not only the destruction of the stock, but also the growth of the business. We combine these two together and we can see there's a misalignment, which I'll be breaking into as my first point. That second factor now is about the financial health of the company or the quantitative management of the business, a very core key part of the business. And this will help us understand the income statement, balance sheet, and all the numbers behind this business that can help give us a base of the financial health. Now, the third factor is qualitative execution. This includes things like the management of the business, product innovation, and moats that the business is creating. This is a core key element, which I believe most people overlook within this particular business. Not only this, I've got a really great factor that I believe this business has a great moat, so make sure to check that out at the end of the video. But first, if you don't know what HIMS and HERS do, they're basically an American telehealth company that sells prescriptions and over-the-counter drugs online, as well as personal care products. They can include things like hair loss, skincare, all sorts of products that are personalized for different treatments. Not only this, I think it's quite a simple business to understand because it's mainly product driven. So let's cover the first factor now, and that's destruction of the stock. We can see that HIMS and HERS is currently trading at $6.90 and is down 40% in the past 6 months, which is obviously not great. It hit a high of around $12 in Friday, the 5th of May, and since then it's just been destruction. If we move over to the 1 year, we can see the performance is actually slightly better at 10%. But if we take a look at the 5 years, it's pretty ugly. Down 30% over the last 5 years, which considering how much growth this stock is kind of crazy to think. But this isn't the only thing I noticed. I saw that analysts are actually picking up between the divergence between fundamentals and valuation. As earnings beat in HIMS and HERS, it's starting to be picked up that this stock might be stupid now trading at $6.90 when revenue is closer to 60% this year and 30% expected next year. Emphasizing on this point now, let's take a look at the revenue numbers and the subscriber growth in this business because it will be very surprising to you considering the stock performance so far. Into the revenue numbers now, we can see the subscriber growth is 74% year over year from Q2 2022. That was 748,000 up to 1.3 million into Q2 23. 83% revenue growth is a total amount, and that came in from 113.6 million in Q2 22 to 207.9 million for the quarter in Q2 2023. Not only this, we're also seeing expansion in EBITDA adjusted margin growth. That's gone from negative 7% up 5% in Q2 23, which is at 12% swing. Not only this, 90% of this is reoccurring revenue, which is great for multiple expansion. And then 75% of that is also the growth margin profile, which is just a ridiculous number. Not only this, payback period is very low, which is what we want from a business. But if we break this down now for the new beginners on this channel, this will be a much easier chart to understand. We can see the subscriber growth from Q3 2021 all the way through to Q2 23. 74% is a continued growth annually, so that's compounded very well over the last few years. We're also seeing the 30-day subscribers in the multi-section increase, but we're also seeing the single 30-day subscribers increase massively. It's currently at a total of 1,300, and that was closer to 500 only 2 years ago. Not only this, the revenue has also massively been improving. As we mentioned, the 83% is just a fantastic number. It's a ridiculous growth for a company that is currently trading at $1.4 billion. The other thing to mention is the monthly online revenue at the top here. We can see it's fairly consistent at the $50 to $55 range, and that's something that we'll probably want to see expanding in the next few years. But it's not a concern considering the amount of growth of new acquisition of the customers that we're taking on, and that's going to drive revenue anyway. So as long as we're getting that increased total subscribers, that's only going to help benefit our revenue. But by far, I think the biggest and most important thing is profitability, and we're already starting to see this in the adjusted EBITDA margin, going from Q3 21 down 13.2% at negative 9.8 million. We've already started to see that improve quarter over quarter, and now we're positive at 5.1% at 10.6 million. Now, this isn't including things like stock-based compensation, but it's heading in the right direction, which is exactly why I think adjusted EBITDA is a really important factor when using it as kind of a valuation metric. But the final thing to consider in the first factor of destruction and growth is going to be the guidance in which HIMS and HERS management are providing to us. Their long-term profitability targets are estimated for their adjusted EBITDA margin to come in at around that 20 to 30% range, while gross margins is closer to that mid-70s. Not only this, the 2025 trajectory is expected for revenue to come in at around $1.2 billion and that adjusted EBITDA of at least $100 million. So growth of this company is going to be very high into 2025, and I'm expecting that's going to continue onwards. So we're already seeing that the business is in a great place for long-term guidance. Okay, now is this growth organic growth or is it acquisition growth? Two things that is vital to the performance of HIMS and HERS stock. Whether or not this is organic growth, this will be driven through brand and that brand reputation that will increase sales. But if it's through acquisitions, spending money to increase money isn't exactly efficient business management. This is something that happened with TTCF stock, a business which, in my opinion, was in the wrong reasons. It was buying white label services which had low margins, and they were spending money to increase that revenue, which kind of gave a tainted look on the business itself. You look at the business, you think, oh, I see revenue growth, but the business's brand is actually the same as it was before. So this is something we need to look at with HIMS and HERS. Taking a look here at the capital allocation of HIMS and HERS, we can see the guidance for the future investment, which is very encouraging in my opinion. Now, the first thing is that organic growth that we were talking about just then. It's going to be expected to be the primary growth driver for HIMS and HERS, which is a great sign for their brand and their brand name. Now, the second thing is that maintain of payback. The period across the portfolio of less than a year is great for seeing real returns as a shareholder. Not only this, focusing on the investments that drive long-term margins is going to increase profitability, which is going to help with the valuation of HIMS and HERS currently. Now, not only this, investing in durable long-term growth channels through different types of websites, whether it's TikTok platforms or YouTube or other different areas where you can gain new market share, is going to be a big growth driver in helping massively increase the brand awareness. So quick summary in the first factor of destruction and growth, we're seeing divergence very clearly. Stock price is down, growth is up, and we're seeing this in subscriber growth, revenue growth, and now adjusted EBITDA margins. Three factors which is going to help with valuation massively. Guidance looks great, and that they're going to drive this through organic growth, which is what we want to see. No white labels, no bad acquisitions that is just going to increase costs and keep the margins the same without improving the business name and the brand itself. So this is what we're going to get into now, which is a financial health to help us determine whether or not there's actual problems with the business financially and whether or not this is something to do with the poor share performance. Okay, let's jump into the income statement now for HIMS because I think it's really interesting. And we've spoken about some of the parts and I've highlighted the most important parts I could see in the income statement. Now, the first thing is obviously that revenue, which we spoke about, and that's increased from 26 million all the way to 710 million in the last 12 months. But the big key thing here, in my opinion, is that growth margin expansion. It went from 29.2% in 2018 all the way to 80.3% in the last 12 months. Now, this is increasingly good because that can help with margin expansion in terms of valuation, which I'll get into a little bit later. But the other thing to mention now is the unusual items. This is something to consider and dive a little bit deeper in, understand what this unusual item is, whether or not it's a bad or good thing. From what I can see, it's not a big issue, but it's just something to consider when looking at HIMS and Hers stock. Now, the other thing is obviously the net income. We've seen this expand and get worse over the last few years, especially in 2021. They lost 107 million, which isn't great, but that's been coming down quite nicely to 65 million to 46 million in the last 12 months. And hopefully we'll start to see that become more profitable as that adjusted EBITDA margin increases and they start to increase their margins and drive further subscriber growth. Now, the other thing, and probably the biggest yellow flag, I'd probably call it, is the weighted average diluted shares outstanding. As a shareholder, this is one thing we don't like to see. We don't like to see expansion in the diluted shares. This means that we own less of the business as they dilute through increasing that equity of shares outstanding. It's currently at 206 million, and I think the likelihood is most of this is being driven through raising cash or raising through the IPO, which is exactly what HIMS and Hers has been. It IPO'd very recently, so this probably explains the increase in that diluted shares outstanding. Moving over to the balance sheet now, you can see I've once again highlighted the most key important things that I noticed. The first is around the total cash and that short-term investments. It's increased from 41 million in 2018 to 193 million in the last 12 months. And what's great about this is optionality for HIMS and Hers. They've got a huge cash position which they can use for marketing, they can use it for strategy, organic growth, driving that brand awareness. They can use it for buybacks, and anything in terms of reinvesting the business can be used through this great big cash position. Now, one thing which I came in as a yellow flag was more the inventory now. The inventory has been expanding, which is something that we don't like to see, as when inventory is in a recession, it can get outdated and then you have to liquidate that inventory at a cost, which is not what we want. But I think as it's at 21 million, it's still not a significant part, which is why I probably consider it more of a yellow flag rather than a red flag. It's something that we don't particularly like to see, but it's not the end of the world, I think, for HIMS and Hers. Now, looking further down, if we look at the total assets, we can see we've got a huge amount of assets at 389 million. And then compare that to the total liabilities of just around 70 million. We can see that the total assets absolutely dwarfs the total liabilities. So HIMS and Hers is in a pretty strong financial position. The other thing is around the debt of the company and the total equity. So first, the total equity of the business. We can see if you're a shareholder, the total equity has been very strong, going from 22.79 to 320, which is a great sign that this business is improving and that they're driving this through growth and providing this back to shareholders from that equity. Now, the other thing is around that total debt, like I mentioned, at 5 million with the cash and cash equivalents of 193 million, there's no chance that this business is going under anytime soon. Even though it's currently unprofitable, they have a big margin of safety with that huge cash position, which I imagine will see them through until they're more profitable in the coming years. We're obviously already seeing that adjusted EBITDA margin increase, and that will eventually translate to real profits in the next few years. Now, I think the final point is around the cash flow statement, particularly free cash flow. We can see that in 2018, this was negative at 57 million, and that went to 75 million negative in 2019. And then it improved in 2020, most likely due to online. That probably scaled and helped increase and pull that demand a little bit forward. Then we went back into 2021 and 22, which was slightly more negative, but 2023 and the last 12 months, we're currently positive at 17.83 million. And considering this business is still growing extremely rapidly, their current objective is much more growth driven than profitability driven. But as that changes over time, we will become a much more profitable company and we'll start to see the fruits of this particular growth. Let's talk about finding some intrinsic value now for HIMS and Hers. And I've got a base case, a best case, and also a worst case. So if we take a look at my actual valuation metrics now, I'm using adjusted EBITDA for 2023 all the way into 2033. So my growth rate I've got in the next 5 years at 30%. And in the 5 to 10 years, I've got that slightly less. As they get bigger, it becomes harder to grow. And then you can understand why the growth rate is slightly lower. Not only this, I've got a discount rate of around 7%, which is typically what the market's been. It's anywhere between 7 and 9%. So in this case, I've gone 7%, just as kind of a discount rate, knowing that the worst case will get a 7% return with these numbers. Not only this, I've got a terminal multiple of 35, which with a percentage of growth of 30%, I think 35 is fairly reasonable for a company like HIMS and Hers. So if we can see here, you can see that the intrinsic value is at 12.5, which would be a double from where it's currently at right now. Now, the best case, which I think could be closer to what we're currently expecting, as a business ramps up, it's going to become more profitable and they're going to be able to drive greater adjusted EBITDA, which I think that the current growth rate at 40% in the next 5 years and then 25% in the next 5 years after that, with a multiple of 40 and a discount rate staying the same with 7%, this spits out an intrinsic value of $23 a share, which is obviously significantly higher for HIMS and Hers. Now, this doesn't mean go out and buy it, because you may have some very different assumptions for HIMS. So don't go off my assumptions, make your own assumptions and understand that this can vary depending on the execution of the business. Now, I will say the execution of the business has been really strong as of recent, but going forward, that can change with many different factors that we're not sure on yet. Now, the third factor is the worst case. The worst case is obviously looking at the points at which we're going completely safe. We want a good margin of safety and understanding what growth rates and where the stock price would be to get that return on investment of around 7%. Now, the growth rate is at 20% I've given for the next 5 years and 15% from 5 years to 10 years with that same discount rate and then a multiple of 25, which may be low considering even at 20 to 15%, the terminal rate you'd expect to be closer to 30 in my opinion. And this does give a present value of $5.59, but if we give a medium average, you can see that the sum comes in at $9 a share, which would be around a 50% increase to where we are today. In my opinion, I think the base case is the most likelihood of the cases at all. I think that the business will become very profitable as that ramps up over time, as they get more benefits through that increased revenue and subscriber count. They'll be able to start to monetize it even more and become a more profitable company, which will help with valuation, in my opinion. So this is just my initial calculations in terms of some sort of intrinsic value for HIMS. Let me know your thoughts in the comments, what you think about this and what prices you have and whether you think it will be the base case, the best case or the worst case. So in summary of the quantitative management of HIMS and Hers, we're in a great position. The financial health looks great. The balance sheet, income statement and cash flow is improving. A couple yellow flags to consider around that shares outstanding and then that inventory increasing, but overall it's in a great position. Not to mention valuation also looks very attractive from some sort of intrinsic value, but I'd recommend doing your own assumptions on this and getting a feel for where you believe the assumptions lie for HIMS and Hers. Now let's get on to my third point, which is around qualitative management and the execution of that management team. Looking at the management expertise now, we are absolutely stacked with great diverse backgrounds, which allows us to get greater insights into many different businesses that we can translate into HIMS and Hers. It's experience with companies like Atomic, Uber, Braintree, Google, all these other businesses such as Walgreens, Gilt, Zola, very different types of businesses which are very disruptive by nature. So having them in our management system, we're going to be able to scale this much quicker with a very experienced team. We've got a great visionary founder in Andrew Dudum, who's going to be able to drive this business. And he's already been driving this business to great scales that most businesses can't scale to. But this is driven through that 4 strategic pillars, which I'll get into now. Now, first, across the 4 strategic pillars, it's that trusted brand. And this comes into that organic growth driver that I particularly want to see. Having that consumer centricity, that data security or privacy, and the partnerships of ambassadors and multi-channel brand developments helps increase that trust and that brand reputation, which we want to see. It helps with reoccurring purchases. It can help with increasing margins, and it just helps having that bigger business brand name in total. Now, the second thing is that leading technology. Having greater technology stack, having greater feedback and insights helps understand our consumer further, and we can give a better seamless customer experience. And that helps us only drive greater revenue in the future. And then into the third point, now we look at the innovative products. We constantly want to be innovating for different products, for different problems. Solving bigger problems is going to help unlock so much more revenue in the future. And we create personalized solutions through that insights, which goes into number two. Then we fulfill this through that research and development capabilities. And with our cash position that we are fully loaded, we can certainly increase this research and development. Now, the fourth is clinical excellence. We have world-class providers, fast and consistent access, and that medical advisory, which just helps give a bit of expertise to the products and gives a better reputation, which is actually driven through real personal advisors. This is only going to help with that brand awareness and increase that relationship between consumer and brand. Okay, but what are Hims and Hers doing to create barriers to entry, making this business more sticky? Well, they're creating a moat through this personalized solutions, which I'll get into now. So the last little gem for you guys is around Hims and Hers personalized solutions. They're at the forefront of a material mix shift in preference towards personalized treatments. And this has already started as of Q2 2021. Hims and Hers have created this hair loss product. They've expanded into skincare, hard mints, hair blends, and even heart health in as of 23 Q3. Not only this, they've seen 20% expansion in subscribers in this particular area, and this is a very sticky part of the business. As soon as you have a more personalized experience, you don't want to deviate from that particular brand, as you get very comfortable with that personalized treatment and you don't want to exclude anywhere else. So this is exactly a fantastic moat that I think Hims and Hers is creating, and I want to see this built out over the next few years. So final summary now, I think Hims and Hers is a really good stock, especially for beginners. It's very easy to understand when you can already see the divergence between the stock price and the growth. Then we look at the financial health. It's in a very strong position with a high amount of total assets and cash, with very little liabilities and very little to no debt. Then you move over to the actual execution of management. Obviously, earnings have been very strong as of recent, and they're also going into this increasing moat through that personalized experience and that personalized treatment. And I think this is going to be a great driver in terms of increasing and retaining customers and also expanding that brand name and increasing that organic growth, which I like to see personally. Not only this, I think this business has the potential to 2x because the valuation is very good right now. Whether or not this actually translates is up to you, and I want you guys to make your assumptions, but I think this business is in a very good position for long-term growth and also long-term share performance. Now, if you guys enjoyed this video, make sure to drop a like, subscribe if you haven't already, and leave a comment letting me know your thoughts about Hims and Hers, and let me know any feedback about my analysis. That would be greatly appreciated. And I'll catch you guys in the next one. Thanks for watching.